Okay, so the preparation for any central bank is all about a process. The whole point of it being a process is it makes it easy to replicate. It means that you don't miss things. It means that preparing each stage doesn't miss anything and gives you the easiest and clearest way to prevent hesitation, prevent uncertainty come the event. Now, this process will then give you all of your trade opportunities that you need. If something doesn't come up in your process and does happen in the event, well, if you haven't planned for the trade, that's fine. You don't have to trade every single event. Now, the process works like this. First up, you want to be looking at your last meeting. We'll go through each of these individually. Last meeting first, followed by what the expectations are. These come from analysts, what the market's pricing. That tells you where your opportunities are going to be. Next up, what these opportunities are. So where the trades are, what exactly is going to have to change for you to actually get into a trade. So you can now see the opportunities. You now need a plan. How are you going to execute these trades? What's going to mean that you react immediately? What's going to mean that you take a bit of time to think about what's been said, what's been changed? Create your trade plan. So build up these ideas. Then it's a case of execute. Your execution matters as well. You need a plan for your execution as much as you need a plan for your trade. If you can plan your execution, this cuts all the hesitation. This is where you can maximize the trades, because if you have no doubt on exactly how you're going to do the trade, you put it straight on, you can get the correct size on, and that way you maximize your trades. Perhaps the most important part, the debrief afterwards. This consolidates everything you've seen. This is where you can learn a bit more about the way you've traded, about what's been said, about the way the market reacted. Done in real time, this is fantastically helpful, whereas if you look back at a previous meeting and just try and work out what happened, you miss small nuances, you miss the important little bits of information that the debrief will keep for you. Debrief, therefore, makes the review of the last meeting much, much easier, gives you a much clearer idea of what happened, and then helps you out in formulating trades for the upcoming meeting. So that's the process. Let's go and have a look at how exactly we do this. So, previous meeting, what you're focusing on really is three key areas. Policy, how it changed. But perhaps more importantly than how policy changed is market reaction. Did the market agree? Did the market disagree? Because the way the market reacts could impact decisions going forward from a certain central bank. So if the market totally disagrees with the policy change, one, it tells you that the central bank could react to that market reaction, but also shows you that the market was potentially completely not expecting that change. And then finally, in terms of clues going forward, any kind of language adjustment, any kind of phrasing, these provide you clues, and that will help come up with new ideas for your next central bank meeting. So that's what you're trying to take from the previous. Policy change, market reaction, language. It also helps you just remember how things traded and gets you in that frame of mind. So next up, expectations. First up, you want to be looking at pricing. What's the market pricing in? And you can do this via OIS, overnight index swaps, or via short-term interest rate markets. What you're trying to gain here is when the next action is. That way you can tell if something happens at the current meeting, whether it's too early or too late, and then how the market is going to react. So this is all about gauging reaction. And telling you where the most important trades potentially are. So once you've got the pricing, you then want analyst research. What this tells you is what people are thinking coming into the central bank decision. So it's where the areas of focus are. Because understanding what others are doing and what others are thinking, again, helps you create your own types of trades. Think about whether the focus is hawkish or dovish. Because this often goes across the board, that you'll go into a central bank meeting with the whole market thinking that you're going to get a hawkish reaction, and so therefore all of a sudden anything dovish becomes so much more important. But being very aware of what all the research is telling you and where everyone is leaning creates some of these outlier opportunities. And by thinking through those, you then spot those opportunities that are really going to pay off, and they're the ones that create the large moves, they're the ones that create the biggest opportunity for you. But if you don't go through and understand how the analysts are viewing things, how people's sentiment going into the event is, then you're not going to be able to pick out what those outliers are. So that's your building a picture. This is all just building up facts. You know, you've got the facts from the previous meeting. You've then also got the facts from expectations and developments. So next up, this is where you're starting to build up an idea of where you're going to get a trade in this. So what you want to be considering is how markets have moved since the last meeting. So this is the sort of preamble, what's happened recently. So say, for example, you're looking at the euro and you're looking at yields. And going into the next meeting, you've seen the euro start to drift on higher, whereas you've seen yields trade reasonably flat. So what this is saying to you is, right, well, there could be opportunities here, and it allows you to start thinking about which market is perhaps going to be more sensitive and in which direction. So clearly this move higher in the euro is to a degree pricing the idea of potentially more contractionary monetary policy. Therefore, perhaps the easier trade in the euro is going to be a sell, because of the fact that you've got a lot of positioning going into this, whereas in terms of yields, so if you're trading bond markets, very limited pricing, therefore they could be a little bit easier to move in either direction. Next up, data. Has it gone up? Has it gone down? Now, this is only going to matter if a central bank is very data dependent. So it's what impact this has had on markets and whether that's starting to skew people's ideas. So that's going to be a key thing. What you could have there in terms of data is that if data has started to improve, all of a sudden there is an expectation that perhaps rates could rise, and you start getting this hawkish expectation just because of a few data points. Think about the Bank of Canada did something very similar to that recently. So you got market moves. Check out your data, understand where the economy is going into these movements, and then commentary. Now this is from central bank speakers, this is from sources, so it's direct commentary. It's not analyst expectations or analyst thoughts, it's actually what the central bankers have been saying. And what you're trying to gauge here is sentiment. You will often get a sense that central bankers will all start moving in one direction, more hawkish or more dovish into a decision. This way, giving a sense of where the central bank wants to go. So first up you go in sentiment, then we get onto specifics. Has anyone actually given a date? Has anyone said something very clear on policy? Because if so, you've now got the opportunity of either a denial or confirmation. And that's where the opportunity lies there, in understanding the specifics in the commentary from certain central bankers. And one last thing, by tracking the commentary as well, possible language change. So Is it that central bankers are starting to use a very familiar phrase that seems to be popping into a lot of their speeches? That way, this could then start to appear in the actual statement. That could be the new language that gets used if there is to be any change. So again, that then starts to build up a trade. So you've got really 3 trades potentially here. You've got language, you've got a denial and a confirmation of any previous specific commentary. So very, very important to start building yourself up ideas of where you've got certain trades. In terms of market moves, it's all about understanding which market is more likely to move on a certain event. So you've had a look at what markets have done, commentary, and what the data is. Next up, you want to be really drilling down on where specifically your opportunities are. So your opportunities generally are going to come from the statement. So for example, what areas of the statement are you going to be looking at? This is an ECB statement, so you may well be looking at the number of purchases or the size of the purchases and their pace. Any key words that they use, any specific phrases that are used from central banks, that's what you're trying to take from the statement. Therefore, again, you can start picking out areas that can change. First up, will the 30 billion change? Next up, or firstly, will well past horizon phrasing change? All of a sudden, you're now starting picking out, if this changes in one way, you've got a trade. If it changes another way, you have a trade. And then we've seen the market moves coming into it. Now what you're looking for is specifics on where you've got an opportunity for a trade. Now if we take a quick example of a market, you'd be looking at this thinking, right, well we've got a double bottom on here. Have we got a trade opportunity on a break of this double bottom and continuation lower? We're already in a reasonably weak market. The market seems to want to go down. So if we get something on the hawkish side in a bond market, is that going to be sufficient to break this double bottom? And where's the trade in that? It's not just about we break it, but this is where your trade plan now starts to think about where exactly is the trade in this. To the upside, quite a bit of resistance. So it does mean that you're going to need a fair bit of news to actually start bringing this market back through areas that have already been traded. So this straight away starts to give you an idea of probably you'd be preferring a trade to the downside rather than a trade to the upside because of the market structure. That's going to help you in terms of deciding on what trades you want to take on and how you're going to take those trades on. Okay, so build up your trade plan. So in your trade plan, first up, you want to categorize the trades that you've got. So you may have a trade around language, around the rates, around some type of market pricing, around a denial of commentary, and these will all fall into one of 4 categories. You first up got a binary trade. This is going to be a trade that has one of 2 outcomes. So very clean cut, it either is or it isn't something. Generally, this is a trade based on the rate or policy specifically. Next up, you've got a specified binary trade. Now, the specified binary trade is one that has numerous outcomes that you know. However, only perhaps 2 of 4 outcomes are important. So this is something that perhaps is on a vote count, whereby certain voting pattern will be important, other voting patterns won't. So it is binary, but only on certain events. You then have a varied outcome trade. This would be something on forecasts. So if you're having a trade off the forecasts that the bank presents, what you're trying to gain here is you can't tell whether the forecasts are going to be slightly better than expected, a lot better than expected, hence the varied outcome. And so what you've got to start deciding here is how far out of line have the forecast got to come before you can then start to decide on a trade with this. So this is all about severity. And then finally, anything interpretation. This is a language trade, so you're looking for specific changes, and that's where you get a trade there. If you're not looking for a specific trade, and again this would then link back to severity, you'd have specifics, and then there would perhaps be a slower trade where you get a sentiment. So is the language more hawkish or more dovish? Now this is a trade that you would plan to be taken on a little bit later. So you've got your ideas. Now categorise every trade. Know exactly what each trade, what category it falls into, 1, 2, 3 or 4, and how this may well change the way you actually execute these trades. So in terms of execution, first up, particularly looking at a binary trade, you're going to have a hit and hold trade. So the idea of a hit and hold trade is this is news that is game changing. You're going to get a very fast move to start with, and then a continuation. What you need to be thinking about with a trade like this is where exactly you want to be in. This is where those levels came. If we looked at that previous one, if you have a level on this red line, your aim is to be in before it. If you can get in before the level, then you're happy with the break to then allow the trade to continue. If, however, you can't get in before, this is where you now start thinking about a continuation trade. Continuation. And what you want to be looking for a continuation, you have two types. You either have the passive continuation, where you're looking to buy a level on a pullback, perhaps a pullback to this red level. Alternatively, you're then looking at breakout continuation to buy the break of this previous high. So you have two types of continuation trade. This could also be something that gets used on a sentiment trade afterwards. You start to realise that the market is believing a certain sort of sentiment from the interpretation and gives you another chance of a continuation trade. Finally, the other trades that you have is a reversal. Now a reversal comes in two forms. You either have a reversal that again perhaps could come on a sentiment idea, perhaps you get a change in policy, but then sentiment is very much the other way. This type of reversal, you're looking for a move that builds higher, starts to pull back, and then breaks lower. And a bit like a continuation, you then have this trade breakout continuation through this low, and then you get the move back down. Whereas with a fade, rather than a reversal trade, you're looking for a specific piece of news that perhaps is enough to move the market, but not enough to keep the market going. So what you're looking for is a move perhaps up to a significant level on not so significant news that then gets traded back. So you're looking here, this is all about price action. You're looking for the market to slow down. You're looking for activity to stall. Therefore, you can sell it at the level for the quick reaction back down. So for every trade that you have, know exactly how you're going to execute that trade. That's going to be very, very important. It reduces hesitation. It stops you thinking, this was quite important, but now I've missed the hit and hold trade. How am I going to deal with this? What am I going to do from here? So be very clear on how you're going to execute every trade, what each trade's execution is going to be, and that way you do not hesitate and you do not doubt yourself. You should all have this breakdown now. This way you can just get all your trades down. Makes it very easy to track your trades, to be able to then go back and even sort of tick off the trade and go, right, that was the trade. What was the trade type? It was a hit and hold trade type. Perfect. So you now know exactly the type of trade it was. You now know what caused the trade as well. These may all vary in terms of data for each central bank, what exactly they're focusing on. But remember, get this all filled out. That way you can just go through it just before the event. You can go through very quickly and get in your head each of the different trades that you want to take. And that way, it makes it a lot easier to pick the trade and take the trade on. Finally, your debrief, and this is perhaps, as I say, one of the most important parts and something that gets missed often. The whole point of your debrief is firstly to get down the facts. What happened? And also how this happened. And what I mean by that is the way that the information gets released. You may well look back and say, oh yeah, well this and this happened, there must be a trade on that. Now, as we all know, looking at a market after something's happened, it always looks like a trade, but perhaps there isn't a trade. So look at what the facts were, what happened, and also, did you get any clues going forward? What this serves to do, not only does it solidify what's happened, it also makes the preparing for the next month so much easier. Next up, trade ops. So what were the trade opportunities out there? And this isn't just the trade, was it a hit and hold, was it a binary trade, was it a specified binary trade? It's all of the opportunities. So for the next 2-3 hours here. So did you get a hit and hold to start with, followed by a reversal, and perhaps this was on a binary trade. Oops. However, language created a sentiment reversal. You get the movement the other way. This way you can go back and you say, okay, right, well, we got a market that fell. It then bounced, consolidated, and then we got the reversal, and you got this break. And that way you look back and you start going, okay, there was a lot more opportunity in this than perhaps you might have thought on this initial move. Maybe this was 2 hours later. But you start then going into next meetings thinking, right, I've got a lot of time to concentrate here. You know, the trade opportunities come later on as well as on that very first move. And then finally, question yourself. How did you trade it? Could you improve your execution? All of these types of things. Where were the additional opportunities? And also your mindset. Were you fully prepared for it? Did you react in the way that you wanted to? So you can go back, you can look back at everything you've done in the preparation and say, okay, yes, I had it planned, I executed it exactly right, I executed just how I expected to trade. However, my mindset was perhaps a little bit hesitant. I got the execution in right, but I rushed out of the trade. So question all of those elements. That way, you start finding new ideas. You start picking out how you can improve, but it also allows you to find new trades. So that's how you want to get your preparation done. And remember, this is just one big cycle. The debrief starts to inform you as to what happened on the previous meeting and makes your preparation for the following meeting that much easier.